Okay, so another issue. Sorry about that. I will record it anyway. We'll share it on YouTube. Sorry for those who missed it or were waiting whatever. I'm just a little bit lost. LinkedIn is not stable platform, I would say. Just to be able to correctly manage Dream. It's much more stable on YouTube. I know that I've been saying this for weeks, months, not years yet, because I only started a year ago. That would move totally to YouTube. It might be really the time right now because I have enough of dealing with all this mess. So either streaming or recording, and then split and send the videos to YouTube for you to watch later. I'll decide, but I'm done with trying to figure out that stuff when, sometimes it works, sometimes it doesn't. We'll see. So like I said, it's recorded anyway. So what are we supposed to talk about today? So you've seen the cover for the Croissant Files this week. This is between Xi Jinping and Donald Trump. The main thing is that someone is lying. Because we have Donald Trump saying that yes, negotiations are going well, we have discussions with China, and China says no, not at all. We have not discussed. We are not ready to chat under these conditions. So obviously someone is lying, and we'll figure it out pretty soon. In my opinion, and the markets will react accordingly, either very positively or very negatively. But it's very likely that once we sort it out, the volatility in the markets will be here. So that's what I wanted to say in introduction. I will go on to geopolitics because this also has an impact on the markets, specifically, and the economy, specifically in Eastern Europe. Rubio said that next week will be a key week for the continuation of the negotiation, if the US is walking away from negotiations or not, if it's stay involved. But at the same time, it's critical because of the deals that are supposed to be made by the Trump administration, and that has actually made by the Trump administration this week, because the U.S. Ukraine Reconstruction Investment Fund launch was confirmed. This is a deal that is supposed to help the U.S. benefit from the resources, the natural resources in Ukraine. It seems to have been basically the objective since the beginning. Anyway, and involve U.S. companies into the reconstructions of Ukraine. So this deal has been signed. However, on the ground, Russia is still making progress, and it doesn't appear to be weakening at this point, which is a big issue specifically for this deal. Why? Because currently, with the eastern region of Ukraine, Russia controls 40% of the natural resources that the US is looking to kind of appropriate. So that's a pretty big issue in terms of between these deals, this deal, between the situation of the ground. Russia is making progress, which makes it unlikely to make serious concessions about to get a peace deal. Actually. I would say that the ones that are usually asking for peace are the ones that are losing the war. So it is what it is, but it's interesting because what Trump expects to get from Ukraine is very likely to be very difficult to get. At the same time, there are other natural resources in the regions of Ukraine still controlled by the Ukrainian government, but there's basically no mine developed at this time on this part of Ukraine. So developing it would require a lot of time, a lot of investments, and this is probably not what Trump is expecting from that deal. And so consequently, when that's probably the reason also that the US might want to walk away from the peace talk, realizing that it will not get what it wants from Ukraine. And this week, so the US has signed a new weapon deal for Ukraine, so in contradiction to what is said. So again, so the situation is evolving fast. We know that Trump wants to get rid of Ukraine and focus on China. This might not be possible. We also know that Trump has decided to focus on Iran as well. Considering the situation in the Middle East, so this probably will. So it's obvious that the alliance between Russia, China, and Iran understand that. So they probably want to keep the war going actually in Ukraine with very little risk for Russia to split the resources, the U.S. resources between there and the Middle East as well, just to prevent a massive operation in the Middle East against Iran, probably. So this is where we are in the Middle East. So in Europe, very rapidly we had massive power outage in Spain and Portugal. It was said in the south of France. I have my son that is living in the south of France, near the Spain border, and he was not impacted at all. So France is heavily reliant on nuclear energy that is providing, some continuous power to the French people, which is different in Spain, which decided to rely heavily on renewables, as well as Portugal. And when they had the problem on the grid, the renewables are kind of intermittent. You have to have either wind or solar for it to work, and sometimes it just might not be enough to sustain the need for power. So just one word like this, in the Middle East, not much, except maybe mentioning the clashes between Pakistan and India that have been escalated. Pakistan said that this week that they were expecting a military action from India. This week it didn't happen, but it just shows how the tension escalated. So I didn't slide that, but just basically that's what I said about the investment fund, the arms deal of the US with Ukraine. So basically we will be able to move on quite rapidly to the economy section of the Croissant Files. Not so live this week. Sorry again about that. So what do we have here? So we are in a trade war with China at this time. So I think it was good to review what the Chinese economy looks like at this time. So there are two manufacturing index in China, the official, which is the NBS, and the Caixin, which is non-official but is heavily followed anyway. And so when you have the official NBS manufacturing index that is in contraction below 50 at this time, the other one is actually not, and it contracted a little bit, but was still higher than expectations. And in terms of size of the Chinese economy, there was an interesting tweet by Elon Musk this week. Why it's interesting? Because he's obviously very close advisor to Trump, and so what he shares is also what he communicates to the president. And what he shared was about what he asked Grok about the XAI, about the relative size of the Chinese economy, the US economy, and the Europe economy in terms of purchasing power, purchasing power parity, PPP. And so basically what it says is that the Chinese economy is about 123 times larger than the US economy and about 1.6 times larger than the European economy. So China is basically, what I'm trying to say is that China is basically not only the the manufacturing of the world at this time. It has evolved. This was the plan from Xi Jinping, well, from the Chinese, and specifically Xi Jinping, since he accesses the in power in China. The objective of Xi Jinping over the very long term, because it's not a democratic country, so they can play very long term if the manager of the Communist Party is doing a good job, otherwise he's kicked out. But they can manage policies over 20-30 years, which the US is not able to do, having an election cycle of 4 years only. So since the midterms are every 2 years into the term, basically this means that Trump only has 2 years to prove kind of himself. And this is why we only 3 months his presidency. It's February, March, April, and he has already hit very hard on every side, but just because he has no choice. So what else can I say about this? Is that yes, you've seen in terms of trade war that the container bookies from China to the US has felt really sharply. Year to year, I think the drop is about 45% for the 20-foot shipping containers. And for instance, there was also some statistics about the port activity in Los Angeles, where the port activity was saying to drop by 33%. So 1/3 of the activity has been reduced. 30% of Chinese customers cancels 30% of bookings. So the 33% that we see in Los Angeles port activity, which is the main one that is coming from China, also is reflected, in other parts in the bookings of the containers the same. So everything is coherent there. I have also friends in the what I would call this in the trade supply industry that have been warning me. But they are in Texas. They are not in California. But even in Texas, which is on the other side, and there are some impacts on the trade supply even in Texas. So this guy has been warning me about storage, emptying rapidly, and what he was expecting is that maybe get some starting having empty shelves on some specific goods, probably not the like of COVID, but some very specific goods coming from very specific country missing at some point. So that will be this is a development that will be interesting to see going forward. So maybe we can move on to before moving on to this, because that is the result of the income coming from the taxes that is lower than usual. What was interesting, in my cover, when I said that someone is lying, I don't want to repeat this, but China has been very how do you say this, very adamant about not negotiating until the US is dropping the current tariffs that they are, deeming excessive, which is probably why why Trump actually decided to reduce some tariffs on some Chinese goods, probably to initiate negotiations. The thing that we've heard this week from China is that China wants tariffs to be removed before having any discussion and entering any negotiation. So this is why it will be very interesting to see, again, at some point this situation will have to be resolved, and when we will have true information about what is actually happening between China and the US, this will very likely have a massive opinion on the markets, because the market has been going up and down basically on rumors at this point. So back to what I was starting to show is that the income from the taxes here, that is much lower than expected. It's been contracting. Why this is an issue? You know that we have a debt ceiling, spending ceiling, and what's happening is that this will have to be negotiated again, because the government may run out of money before than expected. So despite the fact that for, I believe this quarter was the first time that the government spending didn't increase in years, really, thanks to Doge. The contraction in revenue from taxes will actually lead the government to run out of money earlier than expected, which means also that we will go again into the drama of Congress negotiating an extension of the debt ceiling. Well, I would, this is the drama that we see every single time. It makes the headlines. Well, the government will default, blah blah. Obviously, it will not happen. You already have the 23rd hour deal before it happens. But that's the game that is always played at the same time. It's probable that they will play it again, just because of that. We have other information on economic news. So you have the Jolts report that surprised negatively, which very often triggers some kind of a rally in the 10-year yields. So the job openings and labor turnover survey, that's what the jolts mean. It took me some time to remember this one. It's too complicated for me. Job openings, labor turnover survey. So expected negatively, which means that there were less job openings, so everyone is fearing usually heating of the economy, which actually doesn't seem to be the case, but very often that triggers a rally in the 10 years. This remains to be seen. The last 2 days, the 10 years and the long-term treasuries increase as well. So that will be interesting to monitor. In other news about the economy, you see that the Atlanta Fed GDP forecast has been reduced again. That has been dropped from 2.4 to minus 2.7. So that was, if this is a true number, so we might be in an official recession pretty soon. And the data showed that the GDP the US GDP contracted by 30 bips, so minus 0.3% in the first quarter, when it was expected to expand plus 0.3% in the first quarter. So that's much lower, and that's at the same time, the GDP price index also surged plus 3.7%, which is the highest since August 2023. So that's kind of the Fed's nightmare that we have been commenting about from some time. Being stuck between inflation and economic contraction, which is often called as the famous S word, which is stagflation. And I don't know if it's if the markets are already pricing kind of like what we had when the Fed started dropping rates last year in September. When the Fed started dropping rates, then the real rates, so treasury rates, started go up. Now you see that the markets are expecting a full point of rate cuts in 2025, which is the double of what the Fed announced. And the last 2 days, basically after the report, the market, so the 10-year and the 30-year rates started going up as well. So we might be again potentially in that situation again. We'll see if the Fed is actually decide to drop the rates. I probably mentioned already last week or a week before that Trump decided not to fire Powell. But we were in the middle of let's say tariff confusion that were hitting the markets pretty bad. So I think that also he made this announcement basically to calm the market and not to add confusion and uncertainty to the markets that would have sent the market lower. I think that when Trump says he's not looking in the markets, obviously he's looking at it, and we'll have some tweets recently showing that it actually does, when he started blaming the current situation on Biden, which I kind of agree with, because economic policies of the former administration were bad, but the reason why the markets were so shaky and drop recently was not about the evolution of the economic situation. It was about the situation on tariffs. This is what rocked the market and brought volatility to the market. So so you have to balance basically everything. On the inflation part, by the way, if we talk about the former administration, we can talk a little bit about inflation that fell slightly, but to 2.3, but it's still above expectation that were at 2.2, and the February inflation was revised up as well. Now, to be fair, for the first quarter specifically, what happened is that most of the inflation coming from the first quarter was related to the inflation in the last month of the Biden presidency in January. Since then, it dropped in February, and in March, the inflation basically was flat and the prices did not increase. I think it was basically fair to mention that. So all eyes will be on the Fed next week to see what they do, if they cut, if they don't. That will be very interesting to see, because obviously the market will react to that. Today, the only focus of the markets about the economy is the trade war and the access to cheap money with interest rates. So two things to check at. And we'll see that in the markets right now. Trade war, the impact on the global trade, and what the Fed will be doing. Will they be cutting interest rates? So let's move on to the economy right now. And to move on to the economy, what I need to do is that I need to put my little slider. So sorry about this slide. It's probably smaller than what you would expect. Maybe I can show this here so that you can see slightly bigger. So what I mentioned, Trump is not looking at the market, but he is communicating about the market. So he's obviously watching. The other reason he is watching is that he started changing his rhetoric when the bond markets was suffering. Rhetoric about tariffs when the bond market started suffering. So that's a confirmation that he actually does. We also have here a little chart about the M2, the money circulating, that is still increasing pretty significantly. Yes, I mean, the other thing that I wanted, last thing that I wanted to say about the administration not looking at the market, and they do, and some kind of a funny part in my opinion in the trade war between the US and China. We had Scott Bessent, I think he's Scott, his first name or whatever. The guy said he was surprised that the market rallied after his comment about de-escalation with China. Seriously? I mean, he was surprised? No, he was not. It was a totally calculated move for the market to bounce back and not cave. The market was shaky. There was, as we've seen in the market dashboards over the last few weeks, that the activity in the market, and specifically in the stock market, were large, were heavy. The volatility was high. So they had basically to calm down the market at this point. And no, I don't believe a single second that Bessent was surprised that his comments about de-escalation and trade war would have an impact on the market. I just saw that it didn't funny. But what was true about Bessent, he said he didn't say anything new. That's right. I mean, the reality is nothing happened. They just said a couple of tweets, de-escalation, communication with China, that is being denied by China itself. Again, someone is lying, and it's just a game at this point. It's really interesting to monitor just how I would say people are misled, maybe I would say, and are willing to believe what they are said. But we know that markets are a game of anticipation anyway, and so it's natural that when Bessent or Trump say we are negotiating with China, this removes some uncertainty from the market, and things will go better and the market rallies, even if it's not true. But that's how you can manipulate the market pretty easily when you are either a president, at the Fed, or the secretary like Bessent. However, the situation is not as rosy as you may think, for a couple of reasons. First, I mean, nothing really actually happened at this time, so the situation didn't change, and at the same time, we are kind of a more fragile situation. There are a couple of reasons for that. On the rebound, the one that mostly benefited from there was the tech stock, re-increase in terms of concentration of the market to the tech sector, which again makes the market more fragile. you see that, I've shown this here, that the E-mini S&P futures liquidity, the Z-score, is down -3. So we are in an extremely illiquid market on the S&P 500 futures, which again makes the market more fragile. And another sign of fragility is the pairwise, the average pairwise correlation between TLT, so long-term treasuries, SPY, S&P 500, and DXY, which is the US dollar, is rising very significantly. I think it's above 80% at this time. It's on 1 month rolling basis, and it's more actually than during the 2020 COVID crisis, which is often an indication of liquidation, because this is the kind of situation that happens in situations of liquidations of the market. People are not discriminating because what's good, what's bad. They only want to go to cash because they are suffering too much in the market, and liquidating is kind of relieving the pressure when you are under heavy stress and your portfolio is suffering a lot. At some point, you don't have any other option to kind of get out. And that's kind of what these charts are showing at this time. What else? So liquidity Z-score, I've already shown you this. Other thing about the US dollar that is interesting is that the non-commercial traders, so meaning the non-hedgers, the speculators, basically, are heavily long yen and short dollar. And if you are looking at the commitment of traders report and looking at extremes to take contrarian positions, so there are a couple of guys that are doing this very successfully as managers. This is an indication that if it doesn't continue, that could be a positive indicator for the US dollar, considering that the positioning of traders is extreme on that one. So that could be, again, not investment advice, just my opinion. And you see the banner on top. So that could be a positive, let's say, incentive for the US dollar, and a lower, a worse sign basically for the yen. I wanted to show you before moving to the dashboard, foreign central banks transitioning towards gold. So you see that from basically 2012, I believe it's 2014, and specifically, right after the GFC, when so the Great Financial Crisis, when the US started in flooding markets with liquidity, basically reducing the value of the dollar to propel the stock markets higher. This is basically when the rest of the world started, accumulating treasuries and the debt. Now the trend, from, let's say if you look, so it stopped basically in 2012, being flat for a couple of years, and now the holdings in treasuries is going down, when at the same time the debt of the US is still increasing. And what are they doing? They are basically moving to gold. So I've seen that there were comments about China selling gold this week. I didn't find any confirmation, but I thought this was weird. Probably this was here to mention, give some reason, some explanation why gold was, behaving erratically and, went down the last couple of days, and, higher volatility over the last week. But this is contrary to what China has been doing for the last, more than 10 years now, which is accumulating gold and placing itself in a situation where it can control his own money, and also preparing for a large, let's say, financial crisis, I would say. Okay, so now maybe we can move on to the dashboard. Here you go. No, here you go. Okay, so the dashboard that I will put on as a separate video on YouTube. So let's go. So dashboard, we are March 3rd, 2025, and let's review what happened on the market from let's say a numbers and charts perspective, which is my thing. So I'll go much slower, just for you to be able to see what I'm talking about. Let's remove this thing. Oops. Yes, I'm just trying to make it look better for you. So so you see the major asset classes here. What can we note from that? So another slight rebound after the massive rebound that we have before in the SPY. TLT slightly down, nothing major here as well. Treasuries, so interest rates were going down before the JOLTS report that I mentioned before. They contracted, we're going down. They went slightly up after the JOLTS reports, for the reason I mentioned, but nothing really crazy there at this point. I think that the few things to note, and we'll see this in the activity in a couple of screens, is gold. That was down 2.2%. I mean, the correction of the gold is not what is exactly interesting here. What is interesting is that the rise in the 1 month volatility, specifically in relationship to the long-term volatility, is still rising. It's now the second highest volatility increase ratio, let's say activity ratio, in this across the major asset classes, which means this is where the activity is. So if you look at where the activity is, first is the equity market, then it's the US dollar market, in third come the gold market. It's not, it's pretty unusual to have gold and the US dollar being one of the most active, not in terms of volume dollar, but active compared to what it's usually like, which again shows that we are still in a kind of a crisis situation at this point. It's quite unusual. But if you look at gold, not only the activity measured by volatility is high and rising, the activity measured by the volume, which is less reliable, I would say, specifically because here I take the ETF, is also sharply increasing. So usually when you have, and again, this is not an investment advice, when you have that kind of heightened volatility, we are at turning points on the market, either a top, either a bottom, or this is when the bear and the bulls basically are fighting for where to go next. And we seem to be at least in a consolidation phase in gold. So it remains to be seen who will win this war on gold. If, let's say, trade tariffs are over, we don't need gold anymore, everything is fine, and then gold maybe go down, or if the uncertainty remains on the market, and that could push gold higher. So we are in a situation where basically bull and bears are fighting, and we still need to check who will win this fight at this time. IBIT, gold, so Bitcoin ETFs didn't move much. The other important thing to note is the drop in the in oil. This week down 7.3%. Yes, about that, less than minus 7%. And I think it's important because oil used to be an indicator of geopolitical turmoil, specifically in the Middle East. Now we know that there is oil basically everywhere. The US finds oil, Venezuela has a lot of oil, so everyone basically has oil. So the geopolitical turmoil is, in my opinion, not much more a factor in the price of oil, but what is a factor is the global economy and the global trade. And what this drop, despite the market, the US equity markets going up, what I believe the drop in oil means is that trade is slowing. The economy is slowing. We have talked about recession before in the US, and I believe this is a true indicator of what's happening at this time. So before going crazy long on the markets on this rebound, again, not only considering the current volatility of the market, I would be very cautious about going back to be crazy long. You always have to monitor the risk. The risk is your guide here. So we'll see that. So the historical volatility remains pretty high. The implied volatility has reduced. But I mean, it doesn't mean much, to be honest, in my opinion, because the implied volatility is very linked to the drawdown of the market, where the market is. So when we see the market rebounding, having the implied volatility in contracting is basically not a surprise. We often hear that implied volatility is forward-looking when historical volatility is backward-looking. I don't like this, denomination. Why? Because that's, that implies that implied volatility has, let's say, a kind of predicting ability on the market when it actually does not. If you want to use forward for volatility, for implied volatility, I would say it's forward guessing, just like the market. It's an anticipation of what the market will be in a month, just like the S&P is an anticipation of what the economy of what the markets will be, in the futures. We are in market anticipation, so they are basically guessing all the time, not only what the situation will be, but what others will actually do. So that being said, so we have market, rebounding, so and implied volatility contracting when when the historical volatility, even short term like 1 month, is still pretty high. I think I have it here in the next slide. So here this is gold. Actually, you see that gold has suffered a little bit this week. To be honest with you, I mean, it's not dramatic. It's normal that the market breathes. It doesn't always mean that that the market will revert or crash, although it's always a possibility. But when I'm checking that and the reason why most funds and most CTAs are risk adjusting their position is because they want to control the risk globally of their portfolio. And again, it's an indicator very often on where the market is struggling to continue a trend and might be a reversion of the trend, which is why when you have high volatility at turning points, this totally makes sense to take money out of the table for the considered asset. So we see now oil. Very same thing. What I said. I mean, oil has been looking ugly for years now. When we had contraction basically in the economy, in the market, we dropped. So we broke on the downside from very long term, or multi years. This starts in 2020, at least 2022. Yes, I believe. So if you look at the last part of this chart, you very easily see that on Trump's election, we broke out on the upside from this wedge, from this triangle, on the news that Trump would be better for the economy, that would stimulate the economy. But these expectations were reduced very rapidly, specifically when Trump started his rhetoric against China for the global trade. And when he started the trade war, this is when we broke out. So the breakout on the upside was a full breakout. We have a breakout on the downside, which again, it's not good looking for the economy. So market activity. Do I have the detail? No, I didn't show you that. So I don't have the detail, but that's the global average activity. You see that it's still rising, not as fast as it used to over the past week, specifically, the first week of April. It's still rising. What it doesn't show, because I don't show you the detail, is that positive sign is that the activity on the S&P is flattening, both actually on the volatility indicator and the volume indicator. It's also flattening on the US dollar, on the treasuries, but it's spiking on gold at this time, and the increase of this week is largely due to the increase in the activity of gold. So the market is still under tension. And again, I mean, the one thing what I like to say is that you can play the hero there, but the real heroes are all dead. That's how they finish. Another reason, I liked what I wanted to show you. This is one of the reasons that I like to look at cross-market analysis. And you have fund managers, so I don't want to say name, but you have very famous fund managers who have built their career on cross-market analysis. And this is one of them, which is simply a ratio of TLT, so long-term treasuries, versus the S&P. And why is it interesting is that anytime we have a break out of the trend, something is happening. So you had the first break of the trend on this chart, which is the middle of the chart, when you see TLT spiking versus the S&P. When was it? It was when we, at the beginning of August 2024, when everyone was fearing about the carry trade unwinding that could trigger massive implications on the, not only on the forex market, but the bond market as well, which is really the keystone, what holds everything, and then consequently the stock market. So we had that break here, which again signed heightened tension at this point. And if you look at more recently, so we had this trend broken at the beginning of March. Which is when the market started going down. Now the positive news for, let's say, today and for the last 2 weeks with the rebound is that the bonds are underperforming and have broken a pretty short-term trend. So, and the bonds are underperforming versus US equities, S&P specifically here. So that's a positive sign. Again, everything has to be taken in balance. The price action itself, that kind of sign, the risk in the market, and that's what makes investing pretty difficult. So in terms of relationship, you see here that if you look at the Nasdaq or the large caps, let's say Dow Jones Industrial Average, and the small caps here, when the market rebound in sync, large caps and small caps didn't outperform the S&P. The only that outperformed the S&P is the Nasdaq. Again, money going back to the tech sector with hopes of reduction of the trade war. We'll see what happens, but it's not like the things that had been massacred before, or the things that were searched for before are coming back into favor. When the crisis started, we saw that the large caps, so let's say the top 30 from the Dow Jones Industrial Average, were looking like kind of a refuge. They were overperforming the S&P and the Nasdaq, when the small caps were very significantly hit by the trade war. Now that kind of in the market, the sentiment about this trade war is kind of easing, we don't see the small caps recovering massively. So I think that's a big deal, because it's these are the ones that will probably be more impacted by continuation of the trade war, and so we've seen some reduction in the large caps towards the tech sector, but it's not massive. So we'll have to see. Specifically this week, rise in the US equity market shows some signs of, I would say, not weakening, but it's not like a V-shaped recovery like in 2020, or some kind of V-shape, violent V-shape that we had, for instance, in 2008, for instance, 2009 at the bottom of the GFC. So this is why probably the markets are waiting for the Fed, waiting to see what they will announce. That would again that will be very interesting, because the Fed is under the microscope at this time. No surprise here in the equity market, consistent with the price action. The defensive sectors such as consumer staples, utilities, healthcare were underperforming the S&P recently when they were overperforming during the crisis. That's natural, but that's another way to see where the sentiment is going in the market just by looking at prices, basically. You know, if you actually look at what the market was doing, you could say that because utilities were overperforming basically since the beginning of 2024, so you could say that the concerns about the market going up this way were increasing, and we had, you know, increase in in utilities at the end of February, beginning of March, rising significantly, and during basically the drop. So that, you know, that's another kind of way to measure the sentiment across the market. And maybe last thing, so we have markets going up. So equity markets going up and gold going down. So all the, you know, what I've shown you the weeks before about the market tanking, well, versus gold, specifically, whether it was equities, US equities, European equities, US dollar, treasuries, you know, which meant there was really a rush towards you know, safety, basically. And you can see this, you know, on the S&P specifically since the beginning of 2025. I mean, it was clear all 2024, 2025 on the treasuries, on the US dollar as well. The last one that collapsed was the European stocks, but you know, there was a part of reallocation from the US to Europe that we talk about that was part of the impact on these two. So I think we're good for today. Let's move back, and yeah. So again, sorry you probably couldn't see it on LinkedIn. I don't know what LinkedIn is doing, but I'll probably try to avoid this in the future. Let's do it YouTube only next week to see how it works. And again, we'll go from there. Thank you very much for being here as usual, and enjoy your weekend and have fun. Thank you. Bye-bye.